Good morning, Orlando. I'm thrilled to be here. I'm thrilled to see everybody here. What a year in markets. It is just as volatile as I remember in 2008. Policy changes, markets reacting, so quite a year. When I spoke to the great folks at the MoneyShow about this presentation a few months ago, the big conversation in markets was that American exceptionalism was dead, done. That the American investing project was going to be overtaken by a resurgent Europe, and that the policy choices in the country meant that the returns in the S&P and other indices in the US were going to lag those of the rest of the world, despite massive outperformance since the global financial crisis in 2010. I can't tell you how actually offended I was by that, because it flies in the face of everything we know about markets. I've been doing this now for almost 30 years. And yes, you have years where the US markets underperform, such as we have this year because of the weaker dollar. That means other assets do better in the rest of the world. But the fundamentals of what happens in this country to capital and investing and investor protections cannot be equaled anywhere else in the world. And I felt so strongly about it, actually, that I wrote an editorial for Barron's in May about how the conversation was misguided. So today, we find ourselves in a different situation with talk about bubbles. Bubbles in AI, bubbles in valuation, and just bubbles in everybody wanting to get into the market. And the bottom line is that we say this is not a bubble, in part because, frankly, if we're talking about a bubble, we're probably not in a bubble. The bubble happens to the places of the market and in the economy where you're not paying attention. So with that, let's get going. Earlier in the year, we had massive policy shocks. This is an administration that wants to reorder trade and reorder supply chains. And almost by definition, that means there's going to be dislocations. And we saw that reflected in markets in the first 4 months of the year. As the policy changes came through, economists on Wall Street dropped their estimates for global growth in March, April, and near May. And what you see very clearly is that since that time, the economy has been remarkably resilient. And in fact, GDP growth estimates have been coming higher. This explains, of course, why the market is recovering, because in fact, the worst case scenario not only did not happen, it isn't happening. And in fact, the US economy is so flexible and corporates are so flexible that actually the companies are very well versed in how to move and take the environment as it is and move forward. So we think GDP is coming in much better than expected this year. We have said so since May. Our clients have benefited from that because we kept to our guns and we kept everybody invested in the market, even when the S&P touched 4,800 one morning, which that was a tough morning, but it was for a day. What's going on with the tariffs? You know, it was a big conversation earlier in the year, and I just want to unpack it a little bit for you so you understand why markets were so concerned about the tariffs and why, in fact, we don't see a big hit from tariffs. So, yes, we know the tariff rate as proposed on Liberation Day was about 21% of imports. That is up from 3% on January 1st, 2025. So a huge shock. Why did it matter? Like, why does it matter? Well, let's do some basic arithmetic. US GDP is about $30 trillion. A 21% tariff was about $700 billion. And if you think the US grows about 2% a year, that's about $600 billion. So what the tariffs at that rate were going to do was to take away 2% of growth in the US economy. And that's why the markets dropped immediately, because it looked like we could go into a recession. A $700 billion tariff rate acts like a tax, and so you take away 2% growth on a $30 trillion economy. That's why the markets dropped 20%, and that's why every economist out there called for a recession. But that really doesn't tell the whole story, because in the background what was going on is the administration was actually negotiating deals, and the day that they postponed the tariffs on April 9th, I'd say that's the last time the market really cared about tariffs, because it was understood that whatever the final rate was going to be lower. And at the same time, Congress was working on the tax bill. And what the tax bill did, as passed on July 4th, is that it gave corporate America tax incentives and money back from the government to cover whatever dislocation was coming from tariffs. And so I actually love this, because the tariff rate here is coming in at about 15 or 16%, and that is the red line. The blue line is the probability of recession. And what you see here is that the probability of recession dropped dramatically as soon as the first draft of that tax bill came through, because it was clear that the U.S. economy was going to be sterilized from the dislocation that the tariffs could inflict on the economy in the short term. And in fact, that's exactly what happens. And now probability of recession is almost near zero, while the tariffs, frankly, are still bringing in $350 billion annualized of revenue, 1% of GDP, good for the U.S. Treasury. And so the markets took off, and they took off because you can't look at a policy change in isolation from other policy changes. So the market now thinks less of a probability of recession. We're still bringing in annualized about $350 billion of tariffs. It's going right to the U.S. Treasury, and of course it's helping to ease current concerns about the deficit. Inflation remains sticky. Inflation remained sticky before the tariffs. The Fed's target is that red line there, which is 2%. And we came in CPI. We're using CPI here because that's what everybody knows and understands and lives with. It has a large component of shelter and rent. And frankly, that's what most folks experience in their lives, is that large component of housing costs. So we like to use CPI. The Fed uses PCE. We are above the 2% target. And the Fed is cutting because you may have heard that the labor market is looking a little wobbly. We agree that the labor market is looking a little wobbly. And the reason the Fed is cutting is because it really wants to avoid the recession at all costs. And so rather than prioritizing inflation here, which is at 2.9% and may go higher because of the short-term impact of tariffs, it's cutting rates. We do think the Fed's going to cut twice more this year because it's mostly focused on not having a recession. I think in the end, we don't want to be the FOMC that allowed the economy to go into recession, worry about inflation. So the Fed is running the economy hot. I think they've done a difficult choice. And of course, not having the data the last few weeks, we missed CPI the other day, we missed the jobs report, making their job more difficult. But the glide path was a view to cutting, and absent anything else, they will still be cutting. That tends to be a great environment for risk assets in the US and globally. Look, the job market is mixed. So the job growth is definitely slowing. A lot of people think that the equilibrium jobs number that you need to produce in order to keep unemployment steady at about 4.2%, 4.3%, is somewhere between 30 and 50,000 jobs. That's a far cry from the 150,000 jobs that it used to be. So it means you don't need as many jobs to be produced monthly in order to keep the unemployment rate steady. And that's kind of what we've seen because job growth has been quite weak. So unemployment is still low, but job creation is low also. And, you know, it's sort of like flying an airplane low and slow, low to the ground and slow. There's not a lot of room for error here, okay? So yes, the unemployment rate is steady, but if you're only producing 30 to 50,000 jobs a month, then you're just a little too close to the edge of zero job growth. And in the end, consumption is the lifeblood of the economy here. So we call this a no hire, no fire economy because layoffs are actually contained. So while it's harder for younger people to find jobs, I can tell you just anecdotally, this summer, there were a lot of 22-year-olds graduating from fabulous colleges with no jobs. It's definitely obvious and you can see it. In the aggregate, in the data, it's just not showing up in the aggregate data because the unemployment rate is still low. Having said that, the almighty American consumer is still spending. Americans shop when they're happy, shop when they're depressed, and we consume. Consumption is almost 70% of GDP, and in part that's because the wealth effect coming from housing and the stock market for the last 15 years has really created a wealth effect in the economy, but at the same time, low unemployment. So consumption's still strong, which means you're going to grow. We call this a K-shaped economy, and you may have heard about this. So, the 60% of households that own equities or other financial assets are doing great. And you can see the increase in household net worth in that pink line there. It's really just extraordinary. It's something like $50 or $60 trillion since 2020. The really interesting thing here is not just that household assets have grown in the aggregate, but it's also that the leverage, the balance sheets have healed. So the debt associated with households has dropped. And so that difference, it's that giant gap, that's why households just feel better if they're exposed to financial assets, because debt levels have decreased dramatically since 2009. On the other hand, the chart on the right, you see that credit card delinquencies are going up and auto delinquencies are going up. And this is what you want to pay attention to because the bottom 40% of the income scale is struggling, and this is something we just want to pay attention to because you want to know how far up that goes, creating a stall effect in the economy. Let's get to markets for a second. We'll talk a lot about macro, okay? Markets don't trade on macro. A little bit on rates, a little bit on what the Fed is doing, but the conversation about 1% growth or 2% growth does not affect where your asset prices are. And what affects equities are earnings. And earnings are moving higher. And we put a chart up at other places where you just see like earnings growth has been at a 45-degree angle, and growth has been somewhere between 1.5% and 2.5% for the last, 7 or 8 years. And equities have far outgrown GDP. So while it's fun to talk about GDP, in the end, it's the fundamentals of the market that are driving the equity market higher. And so the conversation about GDP matters only if we think we can see a recession in front of us, because you lose money over the forward 12 to 18 months typically if there's a recession. Other than that, you have earnings growth, markets move higher. What else is going on? Why are we trading at a 22.5 times forward multiple? Well, corporate margins have gotten much better. There's been a massive margin walk from about 13.5% from the global financial crisis in 2009 to almost 19% today. That is a remarkable statement to how efficient corporates have become with their structure and how they run their businesses. And this is the reason, because of the higher margins, we actually think that the 22 times forward multiple is not disqualifying for deploying fresh capital. Meaning, we think we're in a higher margin world, and that means you have higher multiples. It's very rare, actually, to get under that 15 or 16 forward multiple that we had, let's call it, in the first part of the 2010s. Even in 2022 and even in 2020, the S&P dropped to a 15 multiple at the low. So what used to be the high is now the low because the corporate health is much better and margins are much stronger. We don't think big tech is overvalued. That doesn't mean you can't have dislocations. We don't think it's overvalued. Since we're talking about bubbles, we went back to 1999 to say, okay, how is it different today? We know it's different because we know there's revenue, we know there's free cash flow, we know there's actual product, and we know there's actual earnings. But we wanted to put this into numbers. So we took the top 50 stocks, the top 50 tech stocks in the S&P in 1999 and then today. So in 1999, the top 50 tech stocks were almost 2.5 times more expensive than the rest of the S&P. Today, that's only 1.5 times more expensive because there are actual earnings and actual growth rates, not eyeballs, if anybody remembers that. The other thing to talk about is the free cash flow margins, which are really important to why these companies have gotten so big and why the market's moving forward. So again, the free cash flow margins in 1999 were 2%. Today they're 11%. And for IT, and for comm services, they were actually negative in 1999 and today 6%. So the way the market is set up is just much healthier and much better. You can't take a number from today, say, oh, multiples are high, and compare it to history, because the structure of the market is actually very different. The top 10 stocks margin by decade is really remarkable. This is a huge margin walk that we have in the markets, and which is why we think, we've been talking about an expensive market, I think for about 18 months now, talking about 22 times forward earnings. Guess what? We're still there. We're still there, and the market's up about 18% since then. So we're still there because the corporates are just much better. Let's get to the original point that we talked about, economic leadership, and why we don't think the U.S. anytime soon is going to lose from place to the rest of the world. So we went back to 2010. Look at, this is just GDP, plain old GDP, right? The U.S. has grown by 44% in 15 years. Poor UK, 27%. Poor Eurozone, only 21%. And Japan, 13%. And it's really important to keep that in mind because we did say that GDP is not the stock market, but nominal GDP helps produce earnings. And this is part of the reason the consistent growth in the economy, the flexibility in the labor market, the flexibility of the corporate structure, and the ability to pivot and to make strong decisions quickly without having to go through panels or not having a massive regulatory burden is part of what has produced this massive outperformance in the U.S. It's really quite shocking. 30 years ago, the U.S. and Europe were growing at the same rate. Look at what's happened. This is about regulation and innovation, and it happens in America and not the rest of the world. And the earnings are better, and the earnings are much better. So we went back 20 years. The earnings in the U.S., even without the Magnificent Seven, we took out the Magnificent Seven because there's a lot of talk that it's driving everything. So a little bit extent, yes, but even the 493 have so outperformed the world ex-U.S. And even if we took away the dollar effect, it still has outperformed the rest of the world. This is why the U.S. annualized has grown about 11% the equity market since 2010, and the rest of the world somewhere between 0, which is China, and 4%. Stocks follow earnings, not economic data, right? In the end, earnings are up annualized 10% since 2010. The market's up annualized 12%. Remember you heard you were going to get 7% on your equities? Well, for the last 15 years, you've gotten 12% on your equities, and if you bought tech, even higher. Real GDP over the time, about 2.4%, and household median income, 1.2%. So don't look at the economic data, you're looking at corporate data, you're looking at earnings to tell you where the market's going to go. We get guesses all the time. The market's at a new high, should I wait? Really? The market's at a new high all the time because I just showed you these charts of the S&P pretty much moving in a 45-degree angle. So we actually wanted to do a study about this because we wanted to really systemize and quantify this. So we took all the days where the S&P was at a new high versus investing on any other day. And we did it for the forward 1 year, the forward 3 years, and the forward 5 years. And the all-time high is the light blue. And the really amazing thing about this is that if you invested on any day at an all-time high compared to any other day, you actually were slightly ahead in the 1 year, the 3 year, and the 5 year return. So I don't think, that means it's very hard to time the market. And it's natural to think that you're going to wait. We had a lot of clients who, despite our best advice this year, and this is a true story, I won't even say it, it's so upsetting, but sold the market at 5,300 at some point in May, despite our best advice, because they were just concerned. And they kept on waiting for a moment to get in. And in bull markets, and we're in a bull market, very hard to get back in. What we like to do is to pace with fresh capital, do it monthly, do it quarterly, do it every other month, and dollar cost average in. But just because we're at all-time highs doesn't necessarily mean the market's going lower, and actually in history, you're going higher. So it's just remember, the market's up 6 out of 7 years since 1950. This is the long game, and with numbers like that, the house always wins, okay? But you have to be prudent, but investing at all-time highs does not mean you're going down. There are big questions out there. Is the 22 times forward multiple normal? I think the structural issues in the labor market are real, because if it starts to affect consumption, it will affect growth. Recessions don't occur that often anymore, really since the global financial crisis, because Washington, both on the monetary and fiscal side, nobody has a stomach for a recession. As part of the reason the returns have been so great in the S&P and other equity markets, because there are policies that are put in place either by the Fed or the rescues during COVID. So that brings the question, there must be excesses somewhere in the system, because recessions tend to clean out the excesses, and we haven't had that. So I'd say that's sort of a lurking question out there. On the positive side, it means absent a recession, you're likely to have positive years in your investments. On the other hand, it does raise a question, if there is a recession and it comes from out of the blue, what does that mean? You tend to have negative years in the S&P when there is a recession. That's why the market dropped 20% in April, because the policy suggested we could go into recession. Absent that, 10 to 12% corrections or drawdowns are normal and average every single year. The average drawdown, even in years where the market's up double digits, is 10 to 12%. We have to remember that. We have to remember we can't time the market. And we also say, please don't invest with your politics. We do think there is a productivity boom that is helping GDP. We have 3.8% in the last quarter, which is really just remarkable. That's about productivity. And we think that if productivity moves higher and you have the mixture of policies with the Fed cutting, you can get a very high GDP and therefore earnings and therefore markets going forward. There are always risks. Don't think the risks here are unique to any other year. And with that, I think I've been told I'm done. So thank you very much for listening.
We do have time for a few questions, so again, if you raise your hand, I've got a microphone here, Kim has one over there, and we're happy to bring it over to you, or just come on up.
Question, you very eloquently talked about the corporate margin growth and productivity growth at 3.8. Given AI, its influence, and correct me if I'm wrong, has productivity averaged around 2 to 3%? Are these productivity figures part of the corporate margin growth, or is that a different subset of what you're looking to help overall GDP?
So that's a great question, because there's productivity in the macro data, which is easily measured, and the Fed produces that. And then there is the efficiencies that you see in corporate results. So AI is definitely part of the stories. I think one of the questions in the 2010s was this like low and slow economy and the collapse of productivity. We were under 1% productivity in the 2010s. What we've seen in the last few years actually, that productivity is moving higher, and it's actually starting to take a step function higher. Some of that is corporates playing around with AI. It's a snooze or lose world, and it's happening in every company. You heard about Walmart, so it's happening in healthcare, it's happening in retail, it's happening in advertising, it's happening in law firms, it's happening in financials, I can tell you. And so that is part of why corporate margins are getting better. We think that increases because of AI. It will also affect the macro data as well. I think, going back to COVID for a second, I think what we learned, it was really remarkable as somebody watching markets, how flexible and quickly companies retooled supply chains and retooled their businesses. I think that muscle memory is helping deal with the tariff issues now as well, because it's fresh. That is creating the productivity, macro data, as well as the margin growth for companies that we look at to look at earnings.
This has been a market that's had both short-term challenges like last Friday's very brief sell-off, slightly longer-term challenges like the shutdown that's underway, and then even bigger challenges like the Liberation Day sell-off. And yet here we are, we seem to have shrugged those off both on the short-term and long-term. Your thoughts on what's driving that resilience and what the message is for investors today?
That's really important. You can always have down days. I think when you think about adding fresh capital, you have to think ahead 12 months. You must think ahead 12 months. Don't think of this as a trade. You build wealth at least looking at 12 months. You know, we have clients who've got 8 generations of it. But in the end, the trajectory is clear. So yes, you can have 3% down days. You can have a period where you correct 10%. The reason the market is so resilient, as I say, like the noise is noisy, right? Shutdown, tariffs, all of it. The noise is noisy. You have to focus on where earnings are going. And if earnings are marching higher, then that is what you focus on. It's very hard to filter out the noise. But as investors, you have to do it. Don't listen to your friends. Don't listen to the Uber driver, whatever. Like, you look at earnings, and if earnings are moving higher, then the market's going higher. One of the hardest things we had to do for our clients is actually in April to say, you must stay invested, don't sell this. Very hard, because it's emotional, and it's emotional for all of us. Like, well, this is what we do, right? You want your clients not to lose money. Because you always have to think, well, 12 months from now, is the market higher or lower? And if the answer is higher, because this is going to get resolved in one way, then you stay invested and you add more. So think 12 months ahead, look at earnings, the noise is noisy, focus on what's driving the markets, and it's the fundamentals of the market, not the conversation out there. I'd say the one thing, if I can just say, is I think the deficit and the debt issues are real. I think it's going to affect the bond market. And of course, the bond market will always affect if the bond market is the granddaddy, the equity market are the teenagers. So at some point, granddaddy talks to teenagers and say, you're getting a little too excited here. So, the debt and deficit issues show up in the bond market, something to keep an eye on. I do think the administration is going to have some creative solutions here. That is like the one risk I really see out there overall. 12 months ahead, got to think about that. Not what's tomorrow, not what the neighbor's saying. And don't get emotional. It's really hard not to do that. Don't get emotional.
Wonderful. Thank you so much.
Thank you.